Reciprocal tariffs at their core are a tit-for-tat approach to international trade. Imagine country A slaps a 10% tariff on cars imported from country B. In response, country B retaliates with a 10% tariff on agricultural products from country A. This mirroring of tariffs, hence the term reciprocal, forms the crux of this policy. Proponents argue it levels the playing field, ensuring fairness in global trade. Critics, however, warn of potential trade wars, economic instability, and ultimately harm to businesses and consumers on all sides. Imagine you're a farmer in Iowa. You depend on selling your soybeans to China. Suddenly, China imposes a 25% tariff on your soybeans in retaliation for US tariffs on Chinese electronics. This makes your soybeans more expensive in China, hurting your sales and livelihood. This scenario illustrates the potential ripple effects of reciprocal tariffs, impacting industries and livelihoods across the globe. Whether these tariffs will ultimately bridge the gap towards fairer trade practices or ignite a full-blown trade war remains to be seen. The United States, historically, has maintained relatively low tariff rates compared to many of its global trading partners. Current U.S. tariff rates hover around an average of 2.3% to 3.3%. This positions the U.S. among the countries with the lowest tariff barriers in the world. However, other major economies, including but not limited to China, the European Union, and India, have traditionally imposed higher average tariff rates, often exceeding 5%. It's crucial to note that these averages often mask the complex reality of targeted tariffs on specific goods. For instance, while the U.S. boasts a low average tariff rate, it imposes a 25% tariff on imported pickup trucks, a legacy of the chicken tax from the 1960s. Conversely, China might have a higher average rate but applies lower tariffs on certain high-tech imports. This intricate web of tariffs, often dictated by trade agreements and domestic industries, makes a simple comparison of average rates potentially misleading. The implementation of reciprocal tariffs carries significant implications for the U.S. economy, consumers, and businesses alike. One immediate consequence is the potential for price hikes on imported goods. American consumers, accustomed to a steady flow of affordable goods from abroad, might face sticker shock on everyday items ranging from electronics and clothing to automobiles and food products. The ripple effects extend beyond consumer wallets. U.S. businesses reliant on imported raw materials or components in their production processes face a double whammy. Tariffs increase their input costs, squeezing profit margins and potentially forcing them to raise prices, further fueling inflation. Simultaneously, retaliatory tariffs from other countries could curtail access to vital export markets, impacting U.S. businesses' bottom lines and potentially leading to job losses. Section 4. Fairness or isolationism. The debate raging in the shadow of tariffs. The Trump administration's aggressive stance on tariffs has ignited a fierce debate, with proponents lauding the move as a necessary step towards achieving fair trade, while critics decry it as a dangerous slide towards economic nationalism and isolationism. The administration argues that decades of unfair trade practices by other countries, including intellectual property theft, currency manipulation, and non-tariff barriers, have disadvantaged American workers and businesses. Critics, however, contend that this aggressive approach to tariffs is more about economic nationalism than genuine fairness. They argue that the administration's focus on bilateral trade deficits ignores the complexities of global supply chains and the benefits of comparative advantage. Moreover, they warn that this tit-for-tat tariff war could backfire, damaging the U.S. economy, isolating it from key allies, and ultimately undermining the rules-based global trading system. Section 5. A World on Edge. International Reactions and Economic Forecasts. The implementation of reciprocal tariffs has sent shockwaves through the global economy, eliciting strong reactions from international players and prompting economists to issue dire warnings. China, the primary target of the Trump administration's trade actions, has responded in kind, imposing retaliatory tariffs on a range of U.S. goods, including agricultural products, automobiles, and chemicals. The European Union, Canada, and other key U.S. trading partners have also vowed retaliatory tariffs, further escalating the trade tensions. Economic forecasts paint a bleak picture, with institutions like the International Monetary Fund warning of significant risks to global economic growth. Analysts predict a slowdown in global trade, increased inflation, and potential recessions in several countries, including the United States. As the world grapples with the ramifications of this escalating trade war, the question remains, will these tariffs achieve their intended goal of fairer trade, or will they ultimately lead to economic turmoil and geopolitical instability?